You hear about market volatility on the news all the time, but what does it actually mean for your portfolio? In finance, volatility is simply a measure of how much the price of an asset bounces around over a specific period of time. Think of it like a roller coaster. High volatility means steeper drops and higher climbs, which can be unsettling for many investors. Markets react to new information. When data changes or unexpected events occur, investors adjust their expectations, which causes prices to shift. It is important to distinguish between volatility and risk. Volatility is just movement, while risk is the potential for losing your money. This graph shows the difference. The stable asset moves in a narrow range, while the volatile asset swings wildly over the same period. Many long-term investors try to ignore short-term noise, focusing instead on their goals rather than daily market movements. Understanding volatility can help you stay calm when the market gets bumpy. Thanks for watching, and remember to keep learning.